Hi. Welcome to Inference. This is the place where you learn and improve. In this video, I will be talking about antifragility. Fragility, robustness, and antifragility are three related concepts that describe how systems respond to stress, uncertainty, and change. Fragility refers to the property of a system that is vulnerable to disruptions and breaks down under stress. Fragile systems have a limited tolerance for variations or shocks, and they tend to deteriorate quickly when exposed to unforeseen events or changes. Robustness, on the other hand, describes the ability of a system to resist or withstand shocks and variations without being significantly affected. Robust systems are designed to absorb and buffer the effects of stressors, and they are able to maintain their performance or functionality in the face of disturbances or changes. Antifragility is a newer concept that describes the ability of a system to benefit from stress, uncertainty, and change. Antifragile systems are not only able to resist and withstand shocks, but they are also able to adapt, learn, and improve in response to disruptions. In other words, antifragile systems not only recover from stressors, but they actually become stronger as a result of them. To summarize, fragility, robustness, and antifragility describe three different properties of systems in response to stress and change. Fragile systems break down under stress, robust systems maintain their performance in the face of stress, and antifragile systems improve their performance in response to stress. Antifragility is a term coined by Nassim Nicholas Taleb in his book Antifragile, Things That Gain from Disorder. It refers to a property of systems that benefit from shocks, volatility, and uncertainty. Unlike fragile systems, which break down and deteriorate under stress, antifragile systems thrive and become stronger when exposed to stressors. They have built-in mechanisms to adapt, learn, and improve in response to disruptions. Antifragility can be observed in many natural and artificial systems, such as the human immune system, the stock market, and certain types of businesses that are able to withstand and even benefit from market downturns. The concept of antifragility has implications for a wide range of fields, from engineering and economics to medicine and psychology. The human immune system is antifragile because it has evolved to respond and adapt to a wide range of pathogens and environmental stressors. When the immune system is exposed to a pathogen or foreign substance, it responds by generating a specific immune response that is tailored to that particular threat. Over time, this exposure to different pathogens and stressors helps to strengthen and refine the immune system's response, making it more effective and efficient in fighting off future threats. This process is known as immunological memory. Additionally, the immune system has redundant and overlapping mechanisms of defense, which allows it to continue functioning even if one pathway is compromised or fails. This redundancy helps to ensure that the immune system remains effective even in the face of evolving pathogens and environmental stressors. While the immune system can be compromised or weakened by certain factors, such as chronic stress or malnutrition, it is generally considered to be an antifragile system that benefits from exposure to diverse stressors and challenges. Muscles can be considered antifragile because they benefit from exposure to stress and strain. When muscles are subjected to physical activity, such as exercise or weightlifting, they experience microscopic damage and inflammation. However, over time, this exposure to stressors triggers a process known as muscle hypertrophy, which leads to an increase in muscle size, strength, and endurance. The process of muscle hypertrophy is a complex adaptive response that involves a range of cellular and molecular mechanisms, including the activation of satellite cells, increased protein synthesis, and the accumulation of contractile proteins. These adaptations help to strengthen and enhance the functioning of the muscle fibers, allowing them to better handle the stress and strain of future physical activity. Furthermore, muscles have a certain degree of redundancy and overlapping mechanisms of function, which allows them to continue functioning even if some muscle fibers are damaged or underperforming. This redundancy helps to ensure that the muscle system remains effective and efficient even in the face of physical stress and strain. While muscles can be weakened or damaged by certain factors, such as overuse or injury, they are generally considered to be an antifragile system that benefits from exposure to diverse stressors and challenges. The stock market can be considered antifragile because it has a built-in mechanism to adapt and learn from the shocks and volatility that it experiences. In general, the stock market is a complex adaptive system that is made up of a large number of interconnected and interacting agents, such as investors, traders, and institutions. When the stock market experiences a shock or disruption, such as a sudden change in interest rates or a major geopolitical event, the prices of stocks and other securities may fluctuate rapidly. However, over time, these fluctuations can help to reveal valuable information about the underlying dynamics of the market and the expectations of investors. For example, if a sudden increase in interest rates causes the prices of certain stocks to drop sharply, this may indicate that investors believe that those companies are highly sensitive to interest rate changes. This information can then be used by investors and traders to adjust their portfolios and strategies accordingly. Furthermore, the stock market has a feedback mechanism in the form of profit and loss that allows investors and traders to learn from their actions and adjust their behavior over time. In other words, investors who make good decisions are rewarded with profits, while those who make bad decisions may suffer losses. This feedback mechanism helps to weed out inefficient or poorly performing strategies and promote the adoption of more effective ones. Of course, the stock market is not immune to systemic risks and shocks, such as major financial crises or technological disruptions. However, by continuously adapting and learning from its experiences, the stock market has demonstrated a remarkable ability to recover and thrive over the long term. Moving from fragility towards robustness and antifragility requires a combination of strategies and approaches that can strengthen and enhance the resilience of the system in question. Here are some general principles that can help promote this transition. 1. Build redundancy. Introduce redundancies and fail-safes in the system to increase its ability to cope with unforeseen events or changes. For example, adding backup systems or diversifying your investments can help reduce the risk of a catastrophic failure. 2. Embrace variability. Variability is a natural part of any system, and learning to embrace and adapt to it can help promote resilience and robustness. This can involve introducing a certain amount of controlled variability into the system, such as varying your workout routine or experimenting with different investment strategies. 3. Learn from failures. Failures and setbacks are inevitable, but they can also provide valuable learning opportunities. By analyzing failures and mistakes, you can identify areas for improvement and refine your strategies to better cope with stress and uncertainty. 4. Maintain flexibility. Flexibility and adaptability are key components of antifragility, and they can be promoted by developing a range of skills and experiences that allow you to respond to a variety of situations. This can involve practicing mindfulness and meditation, learning new skills or techniques, or seeking out new experiences and perspectives. 5. Emphasize long-term thinking. Antifragile systems are often characterized by their ability to thrive over the long term, even in the face of short-term setbacks or disruptions. By focusing on long-term goals and objectives, you can develop a more sustainable and resilient approach that can withstand the challenges and uncertainties of the future. Nassim Nicholas Taleb's 1/N investment strategy is a simple but effective approach to diversifying a portfolio. The strategy involves allocating an equal amount of capital to each of the assets in a portfolio. For example, if an investor has $100,000 to invest and wants to allocate it across 5 assets, they would invest $20,000 in each asset. The strategy is based on the idea that it is difficult to predict which asset will perform the best in the future. By investing an equal amount in each asset, an investor can effectively bet on the market as a whole, rather than trying to pick individual winners. The 1/N strategy is particularly effective in markets that are difficult to predict or have low correlation between assets, such as the stock market. In these markets, trying to pick individual winners can be challenging, and diversification is a key strategy for managing risk. While the 1/N strategy is simple and easy to implement, it does have its limitations. For example, it may not be the most efficient strategy for all investors, particularly those with more specialized knowledge or expertise in a particular area. Additionally, in markets where assets are highly correlated, such as during times of economic crisis, the strategy may not provide as much diversification as other approaches. Overall, the 1/N investment strategy is a straightforward and effective way to diversify a portfolio and manage risk, particularly in markets where predicting individual asset performance is difficult. Nassim Nicholas Taleb also developed the barbell strategy for probability and risk management. The strategy is based on the idea that the best way to navigate an uncertain and unpredictable world is to avoid the middle ground and focus on 2 extremes. In financial terms, the barbell strategy involves splitting your portfolio into 2 distinct parts. One part is allocated to low-risk, highly stable investments such as government bonds or cash, while the other part is allocated to high-risk, high-reward investments such as startups or emerging markets. By avoiding the middle ground and focusing on these 2 extremes, the barbell strategy aims to achieve a balance between safety and growth while minimizing the potential for catastrophic losses. The low-risk component of the barbell strategy provides stability and security, acting as a buffer against sudden market fluctuations or economic crises. The high-risk component, on the other hand, provides exposure to potentially high-growth opportunities, but with the understanding that some of these investments may fail or experience significant losses. The key to success with the barbell strategy is to maintain a strict allocation between the 2 components and to avoid the temptation to shift too much towards the middle ground. This means resisting the urge to allocate a significant portion of your portfolio to moderately risky investments that may offer moderate returns but also pose a higher risk of loss. Overall, the barbell strategy is designed to help investors navigate the inherent uncertainty and risk of the financial markets by focusing on 2 distinct and opposing investment strategies. By avoiding the middle ground and emphasizing safety and growth at the extremes, the barbell strategy can help to minimize losses while maximizing potential gains. Long gamma is another concept developed by Nassim Nicholas Taleb, a scholar and author of several books on probability and risk management. The term gamma refers to the second-order sensitivity of an option's price to changes in the underlying asset's price. When an investor is long gamma, it means they have a portfolio of options that benefit from price movements in the underlying asset. Taleb's concept of long gamma emphasizes the importance of being positioned to benefit from positive changes in the underlying asset's price, while also being protected against negative changes. The idea is that by being long gamma, an investor can benefit from upside potential while limiting downside risk. One way to achieve a long gamma position is to buy options that are out of the money, OTM, meaning the strike price is above the current price of the underlying asset. These options have a lower upfront cost but also have a higher potential payoff if the underlying asset's price increases. In contrast, options that are in the money, IDM, meaning the strike price is below the current price of the underlying asset, have a higher upfront cost but offer less potential payoff if the underlying asset's price increases. However, it's important to note that being long gamma is not a guaranteed strategy for success, and it carries its own risks. For example, if the underlying asset's price remains relatively stable, the value of the options may decline over time, leading to losses. Additionally, if the underlying asset's price moves in the opposite direction of the option's position, losses can occur quickly and significantly. In summary, Taleb's concept of long gamma emphasizes the importance of being positioned to benefit from positive changes in the underlying asset's price while limiting downside risk. It can be achieved by buying out of the money options, but it also carries its own risks and is not a guaranteed strategy for success. The concept of long gamma can also be applied outside of financial markets and investing, in the context of decision-making and risk management in life. In life, being long gamma means having a flexible and adaptable mindset that is positioned to benefit from positive changes while minimizing downside risk. This can be achieved by having a wide range of options and strategies available and being able to quickly pivot and adjust course when circumstances change. For example, in a career context, being long gamma might mean having a range of skills and experiences that can be applied to different roles and industries, rather than specializing in one particular area that may become obsolete or less in demand. Similarly, in personal relationships, being long gamma might mean having a diverse group of friends and acquaintances, rather than relying solely on 1 or 2 close relationships that may become strained or end abruptly. The key to being long gamma in life is to avoid becoming too dependent on any one particular path or outcome, and instead, to maintain a degree of flexibility and adaptability. By having a range of options and strategies available, and being able to quickly adjust to changing circumstances, individuals can position themselves to benefit from positive changes while minimizing downside risk. In conclusion, Nassim Nicholas Taleb has developed several concepts that have become popular in the fields of finance, probability, and risk management. These concepts, such as antifragility, the barbell strategy, and long gamma, all emphasize the importance of being adaptable, flexible, and positioned to benefit from positive changes while minimizing downside risk. While these concepts were developed in the context of financial markets and investing, they can also be applied more broadly to decision-making and risk management in life. By adopting a mindset that is long gamma, individuals can position themselves to succeed in an uncertain and unpredictable world, and to thrive in the face of adversity. Alright, folks, that is it for this video. I hope you enjoyed it and learned something new about antifragility. If you did enjoy it, please do not forget to like, share, and subscribe. Thank you for watching. Have a wonderful day. Goodbye.